The United States stock market has consistently demonstrated its ability to withstand and recover from major crises throughout its history. It is a testament to the market's resilience that it has survived every significant downturn, including the Great Depression, the 1987 market crash, and the 2008 financial crisis. The S&P 500, a widely regarded benchmark for the overall health of the U.S. stock market, has delivered a positive return in 71% of all years since 1928. This impressive track record is a strong indication that the market can recover from even the most severe setbacks. The data clearly shows that the U.S. stock market has a long history of bouncing back from adversity, and this trend is likely to continue. As we explore the topic of the U.S. stock market's resilience in more detail, it becomes increasingly evident that its ability to recover and thrive is a key factor in its enduring appeal to investors. The United States stock market is renowned for its resilience, and this can be attributed to the system that underlies it. The market is built on a foundation of diverse companies, which helps to mitigate risk and ensure stability. The S&P 500, a widely followed index, includes companies from 11 different sectors, including technology, healthcare, and finance. This diversity is a key factor in the market's ability to withstand economic downturns and adapt to changing conditions. For example, when one sector experiences a decline, others may continue to perform well, helping to offset losses. The S&P 500 is composed of 500 of the largest publicly traded companies in the United States, representing a broad range of industries and sectors. This breadth helps to reduce reliance on any one particular sector, making the market more resilient to external shocks. The diversity of the U.S. stock market is a significant factor in its ability to weather economic storms and provide long-term growth opportunities for investors. The United States stock market has consistently demonstrated its resilience over time. One of the key reasons for this resilience is the hidden mechanism of market corrections. It is essential to understand that market corrections are a normal part of the investment cycle. On average, the stock market experiences a correction of 10% or more about once a year. This may seem like a significant drop, but it is actually a relatively common occurrence. In fact, since 1950, the S&P 500 has experienced a total of 37 corrections, with an average decline of 13.7%. These corrections often create buying opportunities for investors, as they can provide a chance to purchase stocks at lower prices. By understanding that market corrections are a normal part of the investment cycle, investors can make more informed decisions and take advantage of these opportunities to grow their portfolios over the long term. The data clearly shows that the stock market has always rebounded from these corrections, and this trend is likely to continue in the future. When we look at the numbers, it becomes clear that the United States stock market has been a resilient and rewarding investment opportunity for those who have adopted a long-term approach. Despite experiencing numerous short-term downturns and periods of volatility, the market has consistently demonstrated an ability to recover and thrive over time. The S&P 500, which is widely considered to be a benchmark for the overall health of the stock market, has averaged a 10% annual return since 1926. This is a remarkable statistic, and it underscores the potential for long-term investors to achieve significant returns, even in the face of short-term uncertainty. As we can see from this animation, the market's upward trajectory has been steady and consistent, with some occasional fluctuations along the way. By taking a step back and looking at the big picture, it becomes clear that the rewards of investing in the stock market can be substantial for those who are willing to ride out the ups and downs. When it comes to investing in the U.S. stock market, it is the patient investors who ultimately win. These individuals are able to stay invested through downturns, and as a result, they come out ahead in the long run. The data is clear. Missing just the 10 best market days over a 20-year period can cut returns in half. This means that if an investor had invested $10,000 in the S&P 500 index in 2002, they would have seen a return of around $280,000 by 2022, but if they had missed the 10 best market days, their return would have been approximately $140,000. This significant difference in returns highlights the importance of staying invested, even when the market is experiencing downturns. By doing so, investors can take advantage of the market's resilience and come out ahead in the long run. It is essential for investors to understand that the U.S. stock market has consistently demonstrated its ability to recover from downturns, and patient investors are the ones who benefit from this resilience. When it comes to navigating the ups and downs of the U.S. stock market, there are several key strategies that can help you stay on track. Diversification is one of the most important, as it has historically reduced risk by 30% without sacrificing returns. This means that by spreading your investments across a range of different asset classes, you can minimize your exposure to any one particular market or sector. A long-term perspective is also essential, as it allows you to ride out market fluctuations and avoid making impulsive decisions based on short-term volatility. By taking a disciplined and informed approach to your investments, you can help ensure that your portfolio is well-positioned to weather any market storms that may come your way. It is worth noting that the U.S. stock market has consistently demonstrated its resilience over time, with the S&P 500 index having recovered from numerous downturns to reach new heights. The U.S. stock market has consistently demonstrated its resilience, with the S&P 500 index recovering from downturns to deliver long-term returns of approximately 10% per annum. This is evident in the fact that the market has experienced 47 corrections since 1950, with an average decline of 13.7%, yet it has always managed to rebound. For instance, following the 2008 financial crisis, the S&P 500 index plummeted by 38.5%, but it subsequently rose by 252% over the next decade. To stay informed about the latest investing trends and insights, it is essential to stay tuned for more informative content. The U.S. stock market has a history of bouncing back from adversity, with the Dow Jones Industrial Average rising by 331% since its low point in 2009. With this in mind, investors can make more informed decisions and navigate the market with confidence. Stay tuned for more investing insights and analysis to help you achieve your financial goals.